Okay, here we are, and we are on chapter 12. And now we're going to look at some business applications for our time value of money problem. So remember, we're talking about capital budgeting, and capital assets are assets that are going to last a long time. So the first problem we're going to look at is problem 2 and 3. And we are going to consider something called the payback period. Now, companies like to know, and you might want to know if you owned or were investing in a project, how quickly will I get my money back? That is a very common question. Now, the thing is, with the payback period, it does not consider the time value of money. We're going to look at strictly dollars. So we have two different projects. And again, this is problem number, it starts out with number 1. This is Play More Products. And they are considering two different products. They have different patterns of predicted cash inflows. So by the way, what you're seeing here is a typical business application. So year 0 is always the year in which the investment is made. So you see that in both situations they cost $1 million. Year 1, they expect to get $312,500. Now for this project, for the first project, and let me see, what are they calling this project? Well, we can call it Project A. Project A, they expect the exact same amount of money to come in every year, which is really not that realistic, but we'll go with it because that's what the problem is. Problem B, on the other hand, has varying amounts each year of money that they expect to make. Okay, so that's how much they're going to spend for the project, and now this is how much money they're going to make. Now, in both of these, interestingly enough, the dollars are the same, $1,562,500. But again, they're not equal. So the question is, how quickly will they get their money back? Well, if they're the exact same, we can simply say, what's $1 million divided by 312,500? And that's how we'll calculate. And if we do the math, they'll get their money back in 3.2 years. Now, that won't work when we have unequal amounts. So, what we will do is start chipping away. So, we've got the $1 million here, 518. I'll do some math just to show you as we go along. So we're out $1 million, right? We've spent $1 million. Now we're going to get back 518,000. So we still are out 482,000. So it's definitely 1 year. And now we're going to say, let's take 380 out. Okay, that leaves us 2 years. That leaves 102,000. So I've been subtracting, I've been chipping away, and if we divide 102 by 340, 102 divided by 340, that gives us 0.3. So in this situation, it would be 2 plus 0.3 of a year. So for project B, they will get their money back faster. So this is an example of the payback method. Again, equal versus unequal. And clearly project B is better because they're getting their money back sooner. And to repeat the payback period, as you can tell, we did not reference our present value tables, so they don't consider the time value of money. But it's an important metric nonetheless. Okay, how are we doing for time?
5 minutes.
Okay, we will move on then. Let's see, and the eraser. Still on chapter 12.
I'd help him with the erasing.
Oh boy. It's the last chapter, folks. What can I tell you? Okay, so we have the wrong sheet here. Okay, where's my sheet? I know which problem I want to do. I want to do problem number 25. That's 26. Okay, this is problem number 25. 27. Chapter 12, problem number 27. So here is a really good example of a business application using the time value of money. So we have two projects. Project A. So they tell us that Project A will cost $280,000. So I'm going to put that as a negative. That's the cost of the project. The company expects to get $56,000 a year for, let's see how many years, $56,000 a year, 8 payments at 16%. So we will go to our, which table will we use? Well, we have annual payments. They are the same. We want to know what that's all worth today. Because remember, we're comparing the amount of money we're spending today. We want apples to apples. So we want to compare this to how much money we would make discounting the $56,000. So we want present value of an annuity. And that table tells us that we want to multiply this times 4.344, and that will give us annual inflows of $243,264. So that doesn't look very good, does it? No, because it's actually a loss of $36,736. So we're comparing how much money we're going to spend. This is year 0 with the annual inflows. This is Project A. Let's now take a look at Project B. I hope that one's better. Project B. So Project B costs $380,000. And they expect to get 9 annual payments of $74,000. So again, we're going to look at our present value of an annuity table. 9 years, and the interest rate they tell us is 12%. So we will multiply $74,000 times 5.328, and that will give us $394,272. So that's a positive $14,272. So this Project B would be more favorable. So just to repeat, year 0 is always your negative. That's how much money we're spending. And this, of course, is taking into account our time value of money. We're bringing everything into today's dollars. So we want to talk about present value. And in both cases, it's the same amount each year. So it's present value of an annuity. And that, folks, will end this video, and I will see you soon.